Hello guys and welcome. In today's video we are going to talk about stock price, and I believe that most of you, while you're playing the game, you keep on wondering why is it that your stock price is not going up. So by the end of this video you'll have known what's it. So first thing first, we start with the stock price. So what's stock price? We can define stock price is a function of three things. So the first thing is the book value. This book value is defined as total equity divided by shares outstanding, and the equity is the common stock and retained earnings. Then the shares outstanding is the number of shares that are issued at that particular time. Now, how is book value affected? Book value can be affected by the following. While if you issue stock, retire stock, retain profit, or pay dividends. Then the next thing is that the other thing that can really influence the stock price is earnings per share. So the earnings per share is defined as profit divided by the shares outstanding. So you just take the net profit at that particular year, you divide it by the shares outstanding. Then next is the dividend. So if you look at what's dividend, we can say that this is the amount of money paid per share each year. It is set directly by you. You are the one who will decide how much dividend you are going to issue at that particular year. So dividends set higher than the year's earnings per share have no additional benefit to stock price. So the thing is, always ensure that your dividend is greater than 0 and is less than earnings per share. Then the next thing is the summary. So this is how your stock price is in the simulation. You can see that here we have the company name. So we have Andrews, Baldwin, Chester, Digby, Erie, and Ferris. Then here we have the close. This is the last price in the simulation at that particular time. So for example, if it's Andrews, his closing price is $148.03. Then the change, this is just the change or the amount of money that has been added to the stock price or has been removed. So let's say for Chester, their stock price reduced or dropped by $4. Then these shares, these are the number of shares that you have. Then you have the market cap. This is just the market capitalization. So to get the market cap, you just take the share price multiplied by the number of shares, then the book values per share, then the earnings per share, then the dividends, then you have the yield, and here we have price per equity. Then next we have how can you increase your stock price? To increase your stock price, just have to keep your business profitable and ensure that if you want high contribution margin, like let's say you have this extra cash. If you are sitting on cash, try to pay dividends to the shareholders, but make sure that you only pay dividends after you have had earnings. Don't try to pay dividends if you don't have any earnings or you are experiencing too much losses, like you are running into emergency loan. And dividends and again ensure that your dividends have to be less than the earnings per share. Then here we have how to score in stock price. So the thing is, if you want to score in stock price, ensure that you are increasing your stock price each year. And also the other thing is that improve your financial performance. And how can you improve your financial performance? You can improve your financial performance by increasing revenue. This is by focusing on growing your sales through effective marketing and sales strategies. You can also consider expanding into new markets or segments. Let's say if you have you see that you have this market maybe in the low tech or in the high tech whereby there is a vacancy, you can also expand into those markets so that you can increase on your revenue. Then also you can manage costs. So you can implement cost saving measures to improve profit margins. This can include like optimizing production process, you reduce expenses, or negotiating better supplier contracts. Also, you can enhance profitability. You can improve your company's overall profitability by increasing gross margins and reducing operating expenses. Then the last thing is that ensure that you have low debt, like you don't have emergency loan. So you can avoid emergency loan by not producing more than what is in the market can accommodate. Just have a low inventory. So that's it on how you can increase your stock price in CAPSIM simulation. Thank you.